Get your free copy of the complete tutorial at www.teachucomp.com/free. When it comes to preparing budgets, preparing the operating budgets is the first step. In this section, we will discuss the different budget components in the operating budgets. The sales budget is typically the first budget prepared. Every other budget depends on the sales budget. It shows management's best estimate of sales revenue for the budget period. It's important to forecast sales correctly when preparing this budget, using market trends, historical data, and good business sense. Poor estimates can lead to problems in other accounts. Inventory is one of the bigger accounts that could be hurt as a result of poor sales revenue estimates. For example, if management is overly optimistic about sales, inventory could be overstocked, leading to extensive inventory costs. The sales budget is prepared by multiplying the expected unit sales volume for each product by its anticipated unit selling price. The production budget shows the units to be produced in order for a company to meet anticipated sales. This formula shows how to create production requirements. Budgeted sales units plus desired finished goods units minus beginning finished goods units equals required production units. It's important to note that a realistic estimate of ending inventory is essential in scheduling production requirements. Excessive inventory may lead to higher costs for the company, dramatically impacting resources, while too little inventory can have a large impact on sales and customer service. The production budget provides the basis for the budgeted costs for each manufacturing cost element: direct materials, direct labor, and manufacturing overhead. The direct materials budget shows the quantity and cost of direct materials to be purchased. The formula for determining direct materials is direct materials required for production minus desired ending direct materials units minus beginning direct materials units equals the required direct materials units to be purchased. It's important to note that ending inventory is a key component in the budgeting process. For example, inadequate inventories could result in temporary shutdowns of production. The direct labor budget contains the quantity in hours and cost of direct labor necessary to meet production requirements. Direct labor hours are determined from the production budget. The formula is units to be produced times direct time per unit times direct labor cost per hour equals the total direct labor cost. Finally, the manufacturing overhead budget shows the expected manufacturing overhead costs for the budget period. This budget distinguishes between variable and fixed overhead costs. Two other important budget components are the selling and administrative expense budget and the budgeted income statement. The selling and administrative expense budget projects anticipated selling and administrative costs for the period. It also helps distinguish between variable and fixed costs. The budgeted income statement is an estimate of the expected profitability for operations for the period. This income statement will typically contain information from other sections of the operating budgets. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.